Let's unbox the business behind an oil exploration company. Oil is one of the most powerful commodities in the world, but the journey from beneath the earth to the global marketplace begins with exploration. And exploration is a business built on high risk and high reward. At the heart of it, oil exploration companies search for underground or underwater reserves of crude oil. They use geological surveys, seismic data, satellite imagery, and specialized software to identify possible drilling zones. The first major investment is in exploration rights. Companies lease land or offshore blocks from governments, often paying millions just for the permission to explore. Without any guarantee they'll strike oil. Then comes seismic surveying, sending shock waves into the ground and analyzing how they bounce back. This data is processed with powerful AI to predict the size and quality of a potential reservoir. Next is exploratory drilling. This is where the risk gets real. A single exploratory well can cost between $10 million and $100 million. Some turn out dry. Others lead to full-scale development. Success rates around 30%, which is why diversification is critical. If viable reserves are discovered, the company moves to the development phase, building rigs, installing pipelines, and setting up extraction infrastructure. Capital expenditure here can run into the billions. The revenue model hinges on production volume multiplied by oil price. For every barrel pumped, companies earn based on real-time market rates, adjusted for transport, quality, and region. At $80 per barrel, pumping 100,000 barrels a day is over $8 million in gross daily revenue. But costs eat into that quickly. Now let's break down the major expenses. Exploration and drilling, facility construction, skilled labor, logistics and security, environmental compliance, taxes and royalties. Often over 50% of net profit, depending on the country. Operations are typically split into three phases: upstream, midstream, and downstream. Pure exploration companies focus only on upstream, but may partner with bigger integrated oil giants to share costs and reduce risk. A company's valuation depends on its proven reserves, production output, and long-term contracts. Investors also look at hedge strategies, how the company protects itself against falling oil prices using futures or long-term pricing deals. Then there are geopolitical risks. A promising well in a politically unstable country might never generate profits. That's why companies spread their assets across multiple regions. Environmental regulation is another major factor. Exploration often faces public resistance due to potential ecological damage, water contamination, and emissions. This means compliance costs, ESG reporting, and sometimes legal battles. Increasingly, oil companies are investing in carbon offsets, renewables, and low-emissions tech to future-proof their models and satisfy both regulators and investors. Despite all this, global demand remains massive. Oil powers cars, planes, factories, even plastic production. And until energy alternatives scale fully, exploration remains a multi-trillion-dollar industry. But margins are thinner than you think. With oil prices fluctuating and public pressure mounting, only the most efficient, diversified, and risk-savvy exploration companies thrive. And that's the business of oil exploration. Complex, capital-heavy, high stakes, and absolutely foundational to the global economy. This is Business Unboxed. If you found this deep dive insightful, don't forget to like, share, and subscribe for more unboxings of the world's most fascinating industries.